Ajay Srivastava, Managing Director at Dimensions Corporate Finance, is recommending too. Ajay, thanks very much. Good to have you today.
Good morning.
After such a volatile session yesterday, I mean, it really shook up some nerves to see the index plummet right from levels of about 2,300 odd to sub 12,000 in yesterday's session. Do you think that this is something to really worry about, or every decline should be used as an opportunity?
Well, it depends upon what you're holding at this point of time. But I think what is also reflecting is that market, by and large, is heavily invested, but at the bottom of the heart is unconvinced why they are in the market. And perhaps the only reason they're in the market is because of liquidity. There's no reason to be fundamentally in the market in a big way. And certainly in the mid and the small cap, we saw some revival, and that's where the big problem happened yesterday was actually in the small and the mid cap. If you look at the carnage in large cap, it was not very great. The old names flew down a little bit here or there. The consumer name like PVR or Nestle is the world, or even HDFC Bank. You didn't see much of a carnage there. You saw more of the bigger the problem in the small and the mid cap. So I think an unconvinced market could remain on a nerve, remain on the edge. But I think people are ignoring the fact that oil prices remaining high has severe long-term implications for the economy and certainly at the grassroots level. So I think caution is not because of what just happened in one day. Caution is because the economic fundamentals just got much worse than they were previously.
And since you're talking about economic fundamentals, Ajay, we've got the first estimates of the advanced GDP numbers for FY20, which is going to come out today in the evening. 22 economists that we've polled have suggested a figure of 5% for FY20. Now, we know that so far up until now, macros have not been matching up to the market sentiment. But at some point, do you think that the markets would also pay attention to what's happening on ground?
Well, first of all, I think we should ignore this advanced estimate because last 2 years, the estimates have been way off the mark. Last estimate was 7% and we end up with 5%. So I think let's not go by advanced estimate. It is too early in January. I don't know from where they'll get this estimate from. So let's ignore that data point. I think the key data point here which we have to work with is that post the tax cut, which are the companies which are going to benefit and therefore have a higher EPS and a higher profitability. And number two is to look at in the next 12 months, is there going to be a revival of auto sector? Because one of the big issues has been auto sector, will it revive itself? All of the sectors by and large are comfortable. Look at pharma, comfortable. IT, comfortable. Consumers can live with it because there's quite a bit of demand. So I think the big ticket items, variable items are only infrastructure sector and auto sector. My guess is that auto will continue to plod. I don't think there's a great revival happening there for the listed stocks, at least by and large. And for the infrastructure, I think, again, going to be a bad plodding year. So net, I think the assessment is that you'll remain there where you are. And the new stock exchange rules on margin trading on small and mid caps is I don't know if you can put more and more nails in a coffin, but guess is one more nail in the mid cap and small cap coffin because that limits the trading opportunities for people in small and mid caps. So I think you should align yourself with where the market is, economy is, large caps, steady sectors, rupee is worsening and depreciating. So pharma IT is a very, very safe bet to be. Stick to the banking three names, and I think you are good in that. This is not the time to be adventurous and bottom fishing.
Last question, since you brought up banking, I'm going to talk about banking. Key culprits of the downfall that we saw in yesterday's session, the drag that came in from SBI losing about 4.5%. Both the HDFC twins were down. But we have the Q3 update of HDFC Bank, which looks promising. Do you feel that it's still more prudent to stay in these quality names?
Of course. See, if you were to put your money, let me put it very simply. Forget you're an investor or not an investor. If you were to put your money in a bank in India safely, where would you go? What would be your top three choices? Certainly not start with IDFC Bank, etc., correct? So I think naturally safety will gravitate people's money in CASA towards these banks. These banks have a major service edge. And therefore, yes, valuation may look stretched for a while, etc., but I think they have got a serious edge in the market. So no need to change it. I think, at every correction, the twins are meant to buy. Because if India has to move on and more people have to come on, these twins are the paths to, your success and prosperity. If you don't have the twins, you better not be in Indian markets.